Thanks for tuning in to the Bullish Money YouTube channel. It is time for another unfiltered session. Boy, are the markets just sinking or what? I mean, this has gotten pretty crazy. So the major indices, the S&P 500, Dow Jones Industrial Average, and the NASDAQ Composite, they're roughly lost about 3% of market valuation. In nominal terms, we see the S&P 500 lost about 60 points. The Dow Jones has lost 470 points. So this big hoopla that everybody was making last week, in the middle of last week, I think on Wednesday and Thursday, when the markets just, popped up 6-7%, like everybody's like, yeah, we regained $1 trillion of market capitalization. We are on a rebound. I told you bears that you guys are just being too bearish. This is nothing more than a simple market correction. And yet the headlines finally is starting to show some signs of truth. Yahoo Finance, Dow Jones plunges 470 points as oil sinks 8% in grim September debut. 8%. Remember, yesterday, on Monday, the crude oil markets, they jumped up exactly 8%, at least for the Brent index. I'm not sure what happened on West Texas, but I'm pretty sure it was pretty much the same thing. 8% increase in the international Brent crude benchmark. And that was because mainly the bears were covering their short positions. They were taking profits off the table. But now that has come crashing down. Yesterday they tried to play up this oil thing. Like the headline was that there was some supply concerns, some localized supply concerns going on, and that is enough to drive crude oil 8%. Like no. This is just technical bullshit trading, that algorithmic bullshit trading that goes on Wall Street almost pretty much every single time. It doesn't have as big of an effect, but this was just purely technical trading. This was just bears taking profits off the table. Now that those profits have been taken off the table, now the fundamentals start kicking in, and boom, 8% down for crude oil. And we see the indices are just a total wash. I mean, the S&P 500, we are only, where we stand now, which is at 1913 points on the S&P 500. That's about within 1% approximately of the close from last week's Black Monday. So essentially, when I say we've pretty much lost all the rebound rally, we pretty much lost all the rebound rally. I mean, yeah, we're still up, a little bit from the time that the rally started, but not by much. I mean, again, we're only about 1% above the close on last week's Black Monday. And this is where the fun really starts. I really think that last week, when we saw that huge run up in the equities, this was just a bonus. This is just a bonus period for those of you who may not have had time to really research the issues going on, the fundamentals going on. This was a time for you guys to get out at a very fair price, at a very fair valuation, because now the fundamentals, again, people were like having momentary brain damage. It appeared people were saying, that China thing's not that bad. Like, what are you talking about? The China thing's not that bad. On the emerging market thing, it'll recover. Like, what do you mean the emerging markets will recover? I mean, if China is gone, right? I mean, you've seen those empty Chinese skyscrapers. You know that the economy there is just dying. It's terminal. If China's terminal, that means pretty much all the other emerging markets are terminal as well, because the emerging markets, they're emerging because they don't have a diversified economic infrastructure. Their main source of income is to export commodities. Well, if the commodities complex is dying along with the emerging markets, along with China, because there's simply no more demand. Not the kind of demand that we used to have 10 years ago. Now that the demand is gone, we have excessive supply. This is really economics 101. We have too much supply in the financial system. and not enough demand. And these gyrations that we've seen over the past few trades, this is just a run-up to the major 10,000 point collapse in the Dow Jones, because this is simply where the fundamentals are pointing. Now, if you don't agree with me, you don't agree with me. But pretty much it's starting to filter, the news, the fundamentally bearish news is starting to filter in to the speculative markets. And the speculators are saying, all right, we've got our little pop up, now we're popping out. And soon the institutional traders, they will pop out as well. And when they start popping out, guess what? We have a complete bubble collapse in equities. I'm not trying to be a fearmonger. I'm just somebody that wants to tell you the truth. And the truth is, fundamentally, the evidence is stacked against the bullish argument. This is not a time to start buying the dip. You do not want to buy the dip. You will get dipped if you buy the dip. Don't want that to happen, okay? Because the big guys, the Wall Street guys, the social elitists, they have a lot of safety buffer to work through the market volatility. But most of us, millions and millions of Americans, simply do not have that kind of leverage. We do not have that kind of safety barrier. And because of that, every little gyration, every little shenanigan that occurs on Wall Street matters exponentially to you. So you guys need to get out. You simply need to get out. Now we're going to talk about a little bit more technical stuff. I wanted to bring up to your attention why certain quote unquote trusted technical analysis indicators are really, they should not be trusted. And we'll get into a couple of reasons why. We'll take a quick break and we'll come right back. I want to read to you this article that came into my inbox entitled Beginning of the Bear Market. And it's it's written by Brandon Wendell, who is an instructor of technical analysis, apparently. He's got the Chartered Market Technician. Let me tell you something about this certification. The CMT certification is a lot like getting a degree in Egyptology. Now, unless you're Indiana Jones and you're going on this long lost journey to find the Ark of the Covenant, or the Fountain of Youth, or whatever it is that Indiana Jones is looking for, unless you're that guy, Egyptology studies really isn't going to be that useful. And the Chartered Market Technician certification really isn't that useful, because technical analysis, there's a lot of stuff in that discipline that is just completely useless. And I'm going to give you an example why it's useless. And this article is just perfect. So the premise of this article, of course, is looking for signs, signals in the technical charts about whether we are truly in a bear market. And Mr. Wendell is using two indicators, the 40-week simple moving average, which is the equivalent of the 200-day moving average, and the 80-week simple moving average, which is equivalent to a 400-day moving average. The 200-day moving average is the more commonly used. I don't really think too many people use a 400-day moving average, because that's pretty much almost like 2 years of market price action averages. And I mean, that's a little bit extremely long term if you want my opinion. But nevertheless, Mr. Wendell is going to use these two indicators, and he's suggesting to you that when the closing price of the S&P 500 index closes below the 80-week simple moving average, that is an initial sign that we possibly could be in a bear market. Now, the confirmation, however, is when the 40-week average crosses underneath the 80-week moving average, a so-called death cross. This will be, I guess, the equivalent of a very long-term death cross. But when we get this death cross, this long-term death cross, that's the ultimate confirmation, according to this article, that we are truly in a bear market. Now, I want to show you a forecast of what that might look like. Now, I'm going to tell you this is a future forecast. I'm not saying this is what's going to happen. This is just a forecast. This is, again, don't start, commenting me like, hey, this is bullshit. I understand it's bullshit. I'm just giving you a forecast of what it may look like in the future. I'm going out to March of 2017. So this is just an exercise just to demonstrate what it may look like should the 40-week average cross below the 80-week average. Now, if we kind of average out some of the volatility, I anticipate that in a couple of weeks, actually not in a couple of weeks, in a couple of months, around the last week of 2015, in this example, the 40-week average will cross underneath the 80-week average. And that would be a sign, that would be a very bearish sign. And as you can see in the forecast, in the simulation that I've written up here, that indeed the markets continue to drop lower. This is just a potential possible scenario. I'm not saying this is what's going to happen in exactly this time frame, but this is just one scenario out of many that could happen. The important point I want to get across, however, is that notice that the 40-week average crossing below the 80-week, it occurs in the end of December. That's a long time. That's about a 10% differential between the death cross signal and right before the initial market sell-off that we saw 2 weeks ago. Now, 10%, that's a big chunk of valuation. That's a big chunk of your portfolio that just disappears. And it disappears as you're waiting for this 40-week average to cross underneath the 80-week average. The main underlying message here is why wait that long? You see, in the markets, you have to have a little bit of ballsy determination in order to survive here. You got to go with some gut instincts. You got to go before a lot of the troubles start to proliferate throughout Wall Street. And in this case, when you're waiting for that signal to come in, that 40 under 80 week, my goodness, you've lost 10% of your portfolio. And it's good that you're getting out because, you could lose an additional 30%, 40%. But why wait that long? I mean, we already know that the fundamentals are very ugly. We know that the commodities are very ugly. The emerging market economies, they're just not getting it done. So why wait that long? You can give yourself a 10% bonus by getting out early, by recognizing the signs, not the technical signs, the fundamental signs, and getting out before this technical indicator suggests, hey, you're right, we should have gotten out earlier. Why wait for that? I say, it's already common sense that there's so much bearishness being filtered into the system, and there's going to continue to be a lot more bearishness. So you guys don't need to wait this long for a technical indicator. And in my mind, I'm surprised that a CMT is telling you this information. In fact, that's why I told you that the CMT is kind of like an Egyptology degree. Because there's no sense of urgency. I mean, you're going to wait for a 40-week average to go under an 80-week. I mean, my goodness, how much more confirmation do you need than the fundamental news that you see right now, that you saw yesterday? Actually, that you saw years ago, to be quite, blunt about it. Why are you waiting for this crazy mathematical average? Who cares? Who cares? Get out. My goodness. I mean, it's so weird. Like, you're going to look at all these bearish fundamentals and then you're going to be like, no, I think I'm going to wait until this technical indicator says that it confirms the bearishness in the fundamental picture. Like, what are you talking about? Just get out. I mean, I don't know. Some people, and this whole industry of technical analysis, I mean, there's some things I like about technical analysis that I don't want to throw the baby out with the bathwater, certainly. But there's a lot of crap in technical analysis that just, I think it really misleads a lot of people. You don't need to wait this long. I mean, your common sense, your logic, your logical deduction, your analysis, your research, that supersedes whatever crap that you see from some kind of technical, simple moving average indicator, some stochastic indicator or relative strength indicator. We see that there is going an undersold reading here, and according to the moving average convergence divergence line, we need to get out according to the signal line crossing below this black line, red line, forget all this crap. This is just stuff that really confuses a lot of people. Really, just go back to the basics. Okay? Economics 101, like I was referring to in the earlier segment. Just get out. The fundamentals are ugly. They cannot be supported. What you see right now in the technical charts is just algorithmic trading. It's just Wall Street bidding its time to get out at the most ideal opportunity. And that opportunity for them is apparently right now. So you don't need to wait for anything, because if you wait too long, that train will run you over. Ron Insana, or in this case, Ron Insana from CNBC, wants to tell you something. Nobody panic. This is just a retest. That is just completely batshit insane. And the reason why it's insane is because a lot of people fail to understand market psychology. And market psychology is really just human psychology exponentially magnified, because there's money involved. So when there are catalysts that cause people to panic, you can expect that to jump 10 times due to the fact that there is money involved, that there's lots of money involved, that people's retirement funds are involved. The financial markets is a lot like Black Friday in reverse. Now, Black Friday, everybody knows that there's a lot of good deals on Black Friday, and that's why people just bum rush their way into the stores, just literally just tearing each other apart just to get $200, $300 off a flat screen TV. But the reason why it's like that, or part of the reason why it's like that, obviously there's multiple factors involved, but part of the reason why it's like that is because there is foreknowledge. There's foreknowledge that there is going to be this massive door-busting discount, and whoever is there first will get the discount. When there's foreknowledge, that means obviously there's no sense of market risk, so to speak. Meaning that there's no risk of the unknown. You know that there's going to be a discount. But when you have knowledge of something, there has to be something to trade off, because knowledge is power. So if you're gonna have knowledge revealed to you, that means that you have to give up something. And in this case, on Black Friday, you have to give up your time. You may have to even give up your life, because there's so many crazy people out there. Well, in a market panic, it's just like that. It's just like Black Friday, but in reverse. Instead of people trying to get into the markets, people are trying to get out. Okay? So it's the bum rush out that could trample you and kill you. I also use the analogy of Black Friday because in a market panic, people know that there's something fundamentally unsound about the current economic and financial situation. That knowledge is already there. I already told you, knowledge is power. But when you receive that power freely, That means you have to give up something in return. That giving up something in return, again, is your time. You got to get the hell out of there in a market panic. Once it is established that we are in panic mode, that the fundamentals are completely unsound, that the sky is basically falling in this market ecosystem, that means because everybody has this knowledge, whoever gets out first gets out at the best price. Whoever gets out last will get out at the most unfavorable price. That person will get out holding the bag. And that's why I want to avoid this scenario for you. I want you guys to avoid this scenario. I want millions of Americans who work hard, who are just trying to make it through. I want those families, those individuals to get out at the best possible valuation. Because once the panic sets in, the thing is, not only is it reverse Black Friday, but you're also in the last section of the line. You're not on the front of the line. The people that are in the front of the line are the Wall Street hedge funds and the institutional traders. And not only that, but they've already gotten out of the majority of the positions. So they are in the front of the line for the tail end of their wealth allocation. While you're just struggling really to get out, because that's all you have. See, the Wall Street guys, this is just the tail end of their allocation. They're just trying to dump it out because they already dumped it out at the beginning, before even the idea of market panic was settling into people's brains. They already gotten out. So this is Wall Street's final segment of their wealth allocation. Whereas for millions of Americans, it is their primary source of future wealth. And they are desperately trying to salvage whatever they can. So to me, this reverse Black Friday scenario is something that you must absolutely avoid if you want to salvage anything of your retirement, of the majority of your quote-unquote paper wealth. You want to get out at the right time. And you don't have to time it exactly right, but you certainly want to get out before the panic sets in, because I am telling you that once the panic sets in, that's it. You are at the mercy of the markets. You're at the mercy of the free markets. And whatever happens, that's it. That's what you get. So in a market panic, you're not going to be able to set what's known as a limit order. That is an order that you are to sell your position at a very specific price, and if it does not reach that price, then you don't do anything. You hold on to it. Well, you're not going to be able to have that luxury unless you set that limit order way low. Okay? You're going to have to set market orders, or whatever the price of the market is at that time that you place that order. That could be, again, way low. You never know. But you don't have to deal with that if you get out in time. If you get out before the panic, market order, limit order, hey, whatever order, it's fine. You're out. But if you're in and the panic sets in, God help you, because nobody else can. That's our show for today. I hope you have a blessed week, and we'll see you next time.